Ross, we've laid out a number of key themes, I guess, that have been developing over the course of the last several weeks here, notably tariffs, and then notably now the attack on the central bank here in America and perhaps even by extension around the world. What exactly in your mind is the most significant theme to watch for in the markets right now?
Yeah, well, until the end of last week, I would have said tariffs and trade. Obviously, restructuring the entire global trade framework and doing so with such a dramatic tariff announcement on April 2nd would have been the story of the year or potentially the decade. But I think that the threats to the Fed's independence are more important today. I think that the administration would be making a major error by meddling with that. I think there are probably some advisors within the White House camp that are saying so. And if only because I don't think it would help the White House with their goals. I think you would see long bond yields rise. I think you would see the dollar continue to sell off. Obviously, we're seeing a lot of pressure in financial markets from these threats. So I think the threat to the Fed's independence, although maybe still minor, is the story of the day.
Ross, the administration, President Trump himself, has at points in the past become very, very focused on the market reactions that at one point was the ultimate barometer, the ultimate test for whether or not policies were working or not. The president now has shifted his view towards one where the market not necessarily is the end-all, be-all, I guess, judge, jury, arbiter of what's happening with policy. Do we have to worry about that, or is that a tempering effect, at least on the markets in your mind?
I do think you have to worry about it. Part of the reaction to the April 2nd Liberation Day tariffs is that the Trump put, so to speak, was lower or deeper in red than many. Now, we did see, and there's been some reporting that it was the bond market weakness, the big spike in long yields that got their attention and ultimately, helped catalyze the 90-day pause in reciprocal tariffs. There are some Wall Street guys, very successful Wall Street guys who are in his camp. So I do think that he recognizes that there's a pain point where you can have tariffs or trade spill into more of a financial crisis when you start getting into the nuts and bolts of the Treasury market, what it would do to banking and lending. So I do think there is still a Trump put out there, but obviously the equity market volatility and weakness is not really spurring a huge change in policy. So at least on the stock market, I think it's lower than many expected. But the bond market, the moving yields is the thing to watch here.
The tug of war right now that's happening in the equity markets right now is pretty intense. The idea that you have market capitalization weighted indices that are heavily tilted towards big technology names like Meta platforms like Apple, Microsoft, Tesla, and others, versus this broadening out trade for value-oriented sectors. The cap-weighted ones respond more forcefully. The big tech stocks have not really been leaders here. Is that also a worry, and does that change at all in your mind in the next several quarters?
I think it can change in the next several quarters, but I wouldn't expect it near term. These stocks are technically damaged. They haven't been relative leadership since even before the election, really going back to the middle part of last year. And there are some real headwinds, right? Obviously, the trade and tariff stuff hitting chip exporters like NVIDIA. But DeepSeek, I think, has been forgotten because so much has happened in the last couple of months. But there is a real threat to the spending or questions about the spending that have come over investors. And so I think that these stocks are going to be relative laggards, at least for the foreseeable future here. You've got things like financials, industrials, and some of the defensive sectors working pretty well. So it's not like the market writ large is not working. It's just a much more mixed picture. All that said, I would be buyers of these stocks on weakness. I think that in a world where the near-term outlook is so muddy and so unclear, a focus on the kind of structural or secular themes over the next couple of months is going to really pay off. So it might take a steel stomach, but I think that you add to these AI names on weakness here and just kind of hold your breath for the next 6 months and think about the next 6 years.